All right. Welcome, everyone, and happy Tuesday. As everyone makes their way in, if you want to just let us know where you're joining us from today. I know we have some folks from Southern California, the Bay Area. I think we have some people from the East Coast. The chat should be enabled if you want to just let us know your name. Awesome. Melbourne, Florida. George, welcome. You can also tell us about if you're a founder, the startup that you're working on, if you're an investor, which fund you're with. It looks like Karen Frame from Boulder, Colorado. Wonderful. Damien from Oceanside, Mercedes, nice to see you from Palo Alto, running the Silicon Valley program. Amazing, Vancouver, BC. Oh, Cheryl, nice to see you again. I'm excited for you to meet and learn from Angel today. Amazing, Zach. All right, excited to have everyone here. So, without further ado, we have a lot to chat about, and I'm really excited for this conversation. But let me quickly just preface this with a few things. First, my name is Mike Sherbakov. I'm excited to welcome everyone here today to this fireside chat with one of the best investors in the entire world, and someone I'm really grateful to call a friend, Angel Gambino. I am the managing director for Founder Institute for all of Southern California, as well as the Veteran Vertical. For those that aren't familiar with Founder Institute, it is the world's largest pre-seed startup accelerator. So think pre-Techstars, 500 startups, YC. 7,000 companies have been created through Founder Institute, nearly 2 billion in funding, 35,000 mentors across the world, incredible mentors, investors, partners like Angel Gambino. And today's fireside chat is kind of all about investing, fundraising. And I'm excited to introduce you to Angel Gambino. So the format for the session today is we'll do a little fireside chat. I have some prepared questions for the next 30 minutes or so. And then please feel free to ask any questions that you have in the chat. We'll kind of identify the best ones and make sure that your questions get answered as well. Last piece is our next cohort. We run 2 cohorts a year, is starting February 6th. So I know a lot of the founders joining us today have been accepted into that program. Congratulations for those that have been accepted and enrolled. If you're curious about Founder Institute, I encourage you to go to fi.co, take that entrepreneur DNA assessment to get a sense of what kind of entrepreneur you are. See if Founder Institute is a good fit for you, whether going from 0 to 1, ideation to MVP, or that growth stage where you kind of have an early product and you're ready to go out and raise capital and scale. So let's kick this off. Angel Gambino, so wonderful to see you. Thank you so much for joining us today. And I'd love to start off by having you introduce yourself and maybe tell us a little bit specifically about your background and how you came to angel investing.
Yeah, sure. Well, always good to talk to you, Mike. A little more pressure now that this one's, live and other people are listening, but yeah, so a little bit about my background. I started off as a public interest environmental lawyer, working on protecting wildlife and clean water, from an ocean and coastal all the way through to drinking water. And quickly kind of segued into tech. I was really excited when I was in law school. I ran a public interest environmental law conference, and then in '97 we webcast that event, and there were 4,000 people from throughout the world that listened to that webcast. Now, we didn't even have the phrase webcast at that stage, so the fact that they found it, and at a stage when Google didn't even exist, was pretty amazing. And so for me, I saw the power of the internet and knew that that was the kind of direction that I wanted to move into, especially after seeing the inner machinations of Washington, D.C. And so then I kind of, when I segued into startups, I was working with initially a lot of the first kind of big American financial institutions that were moving into online transactions. So just basic banking online. And although I wasn't really passionate about like specific retail banking as a business, I was really excited about creating some of the first, online experiences. And so I worked with Wells Fargo and First Union, who were the top 2 banks at the time. And that was to set up their first kind of, online banking. And so it was great because I got to learn a lot because there were no benchmarks, there weren't case studies, there weren't people who had done it before. So we were all kind of creating it together, which was a really exciting thing to do. And pretty quickly into that, I got an opportunity to work in London. So I was going back and forth between New York and San Francisco, and got this opportunity in London. And I had always, wanted international experience. So it seemed, really exciting, and made that move to London. And while I was over there helping other financial institutions like Capital One and others move into similar spaces and new geographies, I met a bunch of other entrepreneurs. And this is at the time that Tony Blair was prime minister and touting, broadband Britain in the UK. And so really investing a lot in the internet and technology. And so, I got together with a bunch of other entrepreneurs who were looking at, what should we launch? This is like, late 90s, and it was like really heating up in terms of investment and innovation. And it was really exciting time. So we created a company called Gameplay, which was became an online multiplayer gaming service and also games commerce. And that company has survived a few .com booms and busts so far, so it's still alive today. But we floated that company, and that kind of really served as the foundation for me to even think about angel investing. But it wasn't until much later when I had an exit with Bebo, which was a social network that we sold to AOL Time Warner in 2007 for $850 million, that I really started to make my first angel investments. Kind of along that period of time, I'd also been a professional soccer player, as you know, for Queens
I
Park
love that.
Rangers.
That's my favorite fun fact about you.
Yeah, I usually like to hold that one in my back pocket. And I was an exec at the BBC and at Paramount, Viacom. And so at the BBC, I was basically taking the kind of traditional broadcast business and launching their first mobile services, their first internet services, first streaming. So our team created the iPlayer and got the initial approval for the iPlayer, which was kind of like Netflix, but well before Netflix, and or at least as we know it today, and video on demand and all that kind of fun stuff. And learned a lot again, and then brought that to Viacom, where I ran a multi-billion-dollar P&L. And when I was running that business for Paramount, it was really exciting because Tom Freston, who is one of the founders of MTV, came to me and said, like, look, the M&A is heating up, across the US and globally, in terms of media companies really trying to transform from, broadcast into multi-channel and multi-platform. So we're going to need to look at some opportunities to acquire digital businesses. So I worked with the team there then to look at potential, acquisitions, and worked on some of those deals. So I got to see early on, working with investment bankers, working with founders, different ways that big companies would look at either partnering or investing or acquiring startups. So it was really great to get that view from inside, a large corporate, having come from being an entrepreneur and having publicly, listed our gaming company. So having all these different views into the startup ecosystem was hugely valuable. When I had gone from Gameplay to the BBC, that was at the time, that was around 2001. And, right around that time was, when we started to see, just a complete depletion of the market. And then obviously it took a little while to build that back up again. But yeah, and then, when I had my exit with Bebo, I started one of my first investments. Was really about the founders as opposed to the business. I wasn't super confident about the business at that stage, but I was really confident about the founders. And one of those founders is Alex Will, who, went on to be, he's president of Calm, went on to, to build, one of the most successful businesses in the world. And so, so I take that, although I lost my investment on his prior startup, I take that ethos and investing in talent and investing in teams, especially inclusive teams. As a woman, it's really important to me. That's really where you're placing your bets. You're placing your bets on the people first and foremost. And I feel like I learned that then, and it was validated much later. But yeah, and then, I went on to form a venture studio, which partners with large corporates and creates new digital startups that are kind of outside of the business. They may keep those as standalone subsidiaries. They may spin those in. They may sell them. They might kill them. We do that together in partnership with large corporations. That's with Co-Created and with Prehype Venture Studios. So again, I think it's a great way to see how the kind of, big corporate and more entrepreneurial cultures and business models can collide and also, as I say, co-create something of
Mhm.
lasting value. So I think those kinds of experiences have been really helpful in just taking a very holistic view of market opportunities and business opportunities. But yeah, so I've been investing since I guess that was probably 2007. So it's been a while now. And
Yeah.
I invest in seed stage companies that make the world healthier and happier. So, and that can come in lots of different ways: deep science, deep tech, mostly all tech driven. A lot of mental health, a lot of well-being, even into psychedelics, so some life sciences. And then on the happier end of the spectrum, although it's all included, because if you're healthy, that includes mental health, which usually means you're more joyful. But a lot of digital entertainment, leaning into my experience at the BBC and at Paramount. So I like to invest where I think I can add more value than the check that I write. Average check size is anywhere between 50 and 150K. And then when I invest, I usually also ask for an additional allocation to raise a SPV. So then I like to bring in investors that make a cap table more inclusive, and then I manage those investors. So they're typically a lot of times female investors who invested in public markets or perhaps were donors into charities, but hadn't had a lot of experience investing in early stage startups. So I help them throughout that process. And, and in our days when we met through Clubhouse, when I was running my daily fundraising show,
The good
uh,
old Clubhouse
I
days.
know, I know, I got a
We had
lot of
some, yeah,
value. Yeah,
we ran
because
some fun rooms together there for founders and investors. That was great.
totally. And it's, I so value that experience because of relationships and friendships that I've been able to build with people like you. But yeah, out of that one, I decided I needed a kind of overflow room, and that became Angel Club, which is, my community for angel investors and angel stage founders. And that was really to try to help mentor at scale. And so, so we help primarily with fundraising and growth through mentorship and curated introductions and event programming that really fosters those connections and an ability to grow the startup or the portfolio.
Amazing, Angel. Like, there's so many different threads to pull on. I actually really
Yeah.
love that you shared the under the hood and the details of your background and experience, because it's definitely not a linear path. And it
Mhm.
also, I think, points to you understanding all aspects from the very early stage and how do you get things off the ground. And I think, if I'm not mistaken, I mean, for your own startups, you've raised something like $30 million.
Yeah.
Then you've taken them through the life cycle of raising different rounds. When you, just for the founders that don't know, when she talks about M&A, mergers and acquisitions, we're talking about now liquidity events. We're talking about exits, IPOs, and you've been through that process as well, exiting, taking a company public, an IPO, initial public offering. And
Yeah.
so, and then you've mentioned corporate in there. So there's so many different aspects of kind of the founder journey as well as the investor journey that it feels like you understand really well. What I want to double click on, and now we're going to kind of get into the more tactical stuff, because I know a lot of the founders that are joining us today and listening to the recording. And just FYI, for those that need to hop off, no worries, you'll get a link to the recording after this. Um, they're preparing for their fundraise, and I think venture a lot of times is misunderstood. What I love, you and I actually talked about this when we were at the Angel Capital Association event in Las Vegas, and both of us as early stage investors doing mostly, like pre-seed and seed. You talked about like skewing heavily towards founders. You're really betting on founders at that stage. So let me ask like the big question, which a lot of the founders are ask me, is like, what are the key factors that kind of get you across the line to invest? I'll just really quickly say, for me, I kind of look at three things. I look at team, product, and market, and like product velocity. But again, at the early stage, we tend to skew pretty heavily towards founders. So can you maybe touch on like what makes a good investment for you? And then as founders, what kind of qualities are you looking for in founders to be able to feel comfortable writing a 50 to 150K check and then introducing them to your network and then potentially, helping them raise millions after that?
Yeah, sure. So I would say, I've been a founder of like a startup called Sensei, which is an AI, MarTech platform back in 2016. I wish we had the language models then that we have now and the access to data that we have now. I was on the founding team of a handful of other startups in other verticals. And then I had another one called Alchemist, which was a smart mobility accelerator that I sold to Ford in 2018. And when I look at my experience in lots of different verticals as a founder, I've learned something new each time, and I've come at it from both a founder perspective, but also an investor perspective. Like, I put the other hat on, like if I was pitching to me, what would I want to hear? And so to your question, I think as an investor, some of the things that I look for are probably a little different. Like, so recently I joined Influence Partners as a senior advisor, executive in residence. It's an investment bank. It's a boutique investment bank. That's growth stage. So the things that I'm looking at growth stage are really different. And, that I'm looking at still always like very much centered on team, but in terms of the metrics, very, very different at growth stage compared to early stage as an angel investor. And so as an angel investor, for me, I invest for lots of different reasons. And I think it's important for founders to understand why certain investors invest in what they invest in, right? Because the why will really drive a lot of the conversation. So not just what does an investor invest in, whether that's a VC or an angel investor or some other kind, like family office, whatever, some other kind of investor. It's the why that will help you get things over the line. So for example, for me, I'm looking for inclusive teams. As a woman, I know, how challenging it can be to raise capital. It's challenging for all founders, but especially founders who have been historically marginalized from access to capital. And so I would say inclusive teams are important to me. And it doesn't have to be, the founder doesn't have to be, a female or, BIPOC or LGBTQ plus or disabled. For me, it's the makeup of the whole team. So I look for that. I'm really looking for something that shows me that they have unique insights or unfair advantage. So what would make this team, not just the founder, but the team, have a unique ability to succeed where others might fail or where it might take others longer to succeed. So what kind of unique advantages? And that could be, from having specific experience in the corporate world or having experience at another startup. It could be having the pain point that they're trying to solve themselves. So having had, whatever experience it is that they're trying to improve. So I would say some kind of unique perspective or unfair advantage that will give them edge over others that might want to compete or that are already in the market. Sometimes that comes down to, the skill set. So doesn't necessarily have to be, you know, focus on the problem, but maybe they're just amazing at growth and they've found, you know, somebody else who's got a stellar track record with great references, who's an engineer, you know, whatever. I do believe I've been a solopreneur and you know, I will invest in teams where there's just one founder, but I do think it's, you know, you're mitigating risks and, you know, and spreading the workload if you've got co-founders. So I do like to see that more often than not. I think,
Do you want to double
yeah,
click on that? Because
yeah,
I'm very similar. I tell most founders you want to have a good, co-founding team, two
yeah,
founders, three if possible, three co-founders. And that's just like you said, God forbid something happens to a solo founder, especially for the bigger check writers. I know a lot of VCs are this way. You want to make sure that the company can go on.
yeah.
Let me ask you also, do you prefer second time founders or are you comfortable investing in first time founders?
I'm okay investing in first time founders. I do love it when I see a founder that has had prior experience, and even if that startup failed, which most likely statistically it has, that's okay. But I like to see that they were able to get traction, and I like to understand that what they learned from that experience, and I also like to see that they've got some experience fundraising, because that just makes it easier to go into, you know, the next company with those relationships and with that experience. But they can be first time founders, absolutely. Because you got to start at some point, right? Like not everyone starts their right out of, you know, university or in university as founders, but some do. And you know, and when I was talking about the why, you know, I talked a little bit about why I think inclusive teams are important, but I also think, from my perspective, it's got to be a company that, you know, that I care about what they're working on, right? So when I say companies that make the world healthier and happier, um you know, it's got to be, it doesn't necessarily have to be a double bottom line or triple bottom line, you know, business. It doesn't have to be an impact business, but it does. And I don't invest in everything in like mental health, for example. I don't invest in everything in entertainment. It's got to be something where I definitely see the market opportunity, but I also care about the team, the specific area of focus within those broader like thesis categories. And it's also, for me, got to be something where I feel like as an investor, I'm going to be able to help with recruiting talent. I'm going to be able to help with opening up doors for partners and customers. It's got to be something where I am also, as an investor, uh, bringing edge, bringing unfair advantage, right? So that I can help grow the company. Now, I usually only do that on a responsive basis, but I'm, because I don't want to distract the founders by constantly saying like, "Hey, what about this? What about that?" I don't do any of that, but I do say like, "Hey, I met such and such, or I know such and such. Would this be helpful?" And, you know, and then we kind of go from there. And if I can't do that with a business, then that means I'm much more passive. And I have done those investments because I see that I'm very likely to make a return, or at least I feel confident about making a return. But my why is more about me as an investor wanting to make an impact in creating more economic equity and mobility in the world through entrepreneurship. And I feel like in order for me to be effective at that, then I'm not just writing a check. So my why could be different than other investors. There are a lot of investors who are like, they just want to write the check and sit back and, you know, pray. But um you know, but from my why, wanting to create, you know, more economic mobility, that means I am investing typically in these inclusive teams. It also means that I'm trying to do more than just write a check. I'm trying to fulfill a mission. So I would say inclusive teams, if they've got some kind of unique perspective or unfair advantage, it's got to be a problem and market opportunity that I actually care about, where I think I can also make an impact as an investor. I would also say teams that care more about the problem than they do the solution. So, and what I mean by that is there's a tendency for a lot of us to fall in love with our babies, as we should. But sometimes we get so focused on the product or the solution that we are blinded by different iterations or different pivots or different product roadmaps, because we're not really focused on either our ICP, our ideal customer profile, or we're not focused on the real problem that we're trying to solve or opportunity that we're trying to bring to life. So I would say teams that are more in love with the problem or the opportunity than they are their own like product. I think
Yeah.
those for me are some of the key ones.
Those are so many great insights. And again, I wish this was 3 hours long because there's so many different threads to pull on. One plug for FI on this loving, founders that love the solution more than the problem is one great thing about the curriculum is it forces founders to put the blinders on and focus on one thing at a time. And they start with vision, then they go to customer validation before anything else. This is before branding, before you're even building this thing. And I tell founders all the time, they ask me, like, Mike, what do you think about this? And I go, it doesn't really matter what I think. What matters is what the market thinks. What matters is what your potential customers think. And if there was advice I could give to founders, we'll get to the advice piece and common mistakes in a
Yeah.
moment. But it is absolutely that, is like constantly iterating. Founders hear that, but like, what does it really mean? It means validate assumptions, talk to customers, really understand what that problem is, and let them kind of almost create the solution for you. You may have an idea in mind, but it's important to not just think, I've got the perfect solution and I'm going to take this to the bottom of the ocean, because it has to exist this way. You have to think, are you actually trying to solve this problem that you care deeply about, or do you care more about the solution? So anyway, I'm spot on. And I think accelerators in general do a really good job of validating that. One more question on the investor side, because you mentioned, obviously as an investor, myself as a VC, Angel as well, like we're looking for returns. And by the way, one book I recommend to all founders, I'll ask for your book in a moment, Angel, is Secrets of Sand Hill Road by Scott Cooper, first Andreessen Horowitz. It's helpful for both investors and founders alike, but it helps founders understand what investors are looking for. So on the returns, you mentioned that briefly. I know that for us as an early stage fund, for example, we come in at a certain valuation and we're targeting 100x potential. We want every investment we make, I look at it through the lens of, can this 100x from where it is? I know there's a deep mission and why behind what you're doing, but generally, what kind of return profiles are you looking for from founders and the companies that they're building?
So that one's pretty easy for me. So yes, we all love 100x, right? And just to tap into that a bit for founders to understand, like, why do we have these expectations? We have these expectations because, over 90% of the investments that we make will fail. So that means that we're losing our money on the vast majority of investments that we make. And that's because we come in so early stage and it's speculative. There's a whole lot of reasons. But so we need those big hits. We need those big winners in order to make up for those losses. Otherwise, we can't continue to invest because we would have no money left. So yeah, those are great. But for me as an angel, which is a little different than a fund, when I do SPVs, I have LPs like a fund, right?
And real quick, sorry to interrupt, just so everyone understands too, because some founders may not know. Can you talk about
Yeah.
how special purpose vehicles work?
Yeah. So a special purpose vehicle is really, it can also be called a syndicate. And how that works is we're basically raising an allocation or an amount for a startup. So for example, me as an investor, I can just write a check and that will go, directly in that, whether it's a safe or a convertible note or, whatever the vehicle is. As an investor, as a single investor, angel investor, I'm, typically getting, equity for the money that I'm putting into the startup. But what I also do, and what some funds and what other investors oftentimes do, is they will create a special purpose vehicle, which is basically a fund just for that raise. Or a syndicate for multiple raises, but there's an SPV, this vehicle for that individual raise. So for me, for example, I have a syndicate. That means for me that I have SPVs into different companies. And so I do some of your fundraising for you. So it's great when you can get an investor who says, like, yes, I would love an additional allocation, because then that means if you trust that, that investor to be able to fill that allocation, then they can bring a whole lot of investors into your round to help you close that round. And what it also means is that you don't have to manage that long list of investors. So, so when you're,
It simplifies the cap table. So an example for
yes,
a founder would be, you say I'm going to take a $500,000 allocation. You write the angel check for 150. That leaves 350, and you feel confident that, hey, I'm going to go to the investors in my network. I'm going to spin. We call it spinning up an SPV, and you're going to kind of gauge interest from your investor network. You have enough people raise their hands, 50K here, 75, 50, whatever. You fill out the additional 350, but to that founder, you've come in now 150 angel, 350 through this SPV, and you've now invested $500,000 in the company.
that's right. That's right. Exactly. And it means that, I can take investors that are investing like a few K all the way up. I mean, there is not really a limit, but, and so you have what's called a clean cap table. So when you go into later rounds, a lot of investors like to see few investors on your cap table. They don't like to see like 20, 30, 40, 50. And I've seen some crazy cap tables like that, because it's real, like you want to have good investor relations. It's hard to manage all of those investors, because a lot of them will have, they're all humans, they're all different. So they all have different expectations on information. Some have information rights, some don't. So to have an SPV or to work with a syndicate of some kind means that they will manage those investor relationships, on your behalf. And you have that clean cap table going into your next round or your next, conversation with another investor. And, sometimes there's management fees associated with that, and or carry, which operates very similar to a VC fund. That's, when the fund manager will basically take a fee for managing those investors. Sometimes I have a management fee, sometimes I don't. It depends on the particular deal. And then there's, carry, which means that you get, an additional position in that round. So yeah, so for me, I think we were going back to like, what am I looking for in a team? Is that right?
Um, I have so many questions.
Okay, yeah.
Well,
Oh, you know
what we were
what?
talking
I know
about
what
was,
it
oh, sorry,
was. Yeah.
return profile.
Return, yes. So, so with the return profile, for me, I would say, yes, I would love those big hits as often as possible. But, but I would say as long as I'm not losing, I'm happy, because typically with an angel investment, even if you're making a 2X or a 3X, you're still making more than investing in the public markets, right? You're still making more than most other investment categories and other assets. I invest in property. I'm still going to make more as an angel investor if I get a 2 to 3X oftentimes than I will with property. In Detroit, it's a little bit different. I've had 10 and 100Xs on property in Detroit, where I'm from. But so for me, I do look at the businesses where I think they can at least 10X, and 10X is, based on the valuation and the return that I would get as an investor. But a lot of times, what happens is, depending on the trajectory of the company, is that as an angel investor, you're coming in so early that you continue to get diluted in later rounds. So, so there's lots of different nuances in terms of how I view the return. But for me, as an angel investor, and not all angel investors think this way, my return is also like, am I building out my network of other investors and founders? Am I learning something that is helpful to me in other areas of my life? Do I feel good about this product, this service, this solution being in market? Not all investors look at that, but first and foremost, I do look at making a return. I'm okay with those lower amounts of a return as long as I'm not losing. I feel like I'm winning. But I typically look for anywhere from 10x to 100x. And I think when you were talking about earlier about some of the focusing on solutions and the rest of it and books, I would say that the one thing that I think like we all need to do, you were talking about customer discovery. And
Hmm.
I feel like customer discovery is an ongoing thing that we should always do and focusing on, you're saying like, don't ask me, ask the customer, like, or ask, your audience, whoever it is. One of the things that I would say is, a lot of times, when I went to law school, they taught us, how to interrogate people on the stand, right? And you're asking leading questions because you want to get them into a position that they are stating things that help you win your case. And I would say it's the opposite when you're an entrepreneur. You are trying to ask the most open-ended questions, and a lot of entrepreneurs fail when they're asking questions to help validate their assumptions in a leading way, because then you're tainting the data.
It's like, what is your favorite animal and why is it a dog?
Yeah, yes, exactly, exactly. So I would say the quality of the questions and the open-endedness of your questions when you're doing customer discovery is really important. And you mentioned a book, and I would say one of the books, which is by a friend of mine, Thomas Vettel, is called "What's Your Problem?" And it really gets into like oftentimes the problem that we say we're trying to solve is not the real problem. And if you're not solving the underlying problem, then you're probably not getting to the real pain point where the real value creation can happen.
Yeah. Oh my gosh, so many. Okay, again, I wish this was 3 hours long. So many great points here. Let's get a little like now technical because I'm gonna reflect a lot of the questions that I get from founders, and one of them is this tricky area where they're an early stage company. They don't have quite enough traction to instill enough confidence for an angel or a VC to come in, right? That's probably the most common thing that early stage founders will hear. It's what's your traction and come back to us when you have more traction. Honestly, that's just what's going to happen. But then they'll say on the flip side of that, well, I need, outside capital to then get that traction. So, and this actually goes to a question that in the Q&A from Mickey, the first part, which is like, how do you evaluate traction of a startup that hasn't generated revenue yet? And then what would you say to those founders? Because I find a lot of them are in that spot. They say, I need capital to get traction, but the investors are telling them they need traction to get capital. What are your thoughts there?
Yeah. So, there are, founders who are able to raise on a plan, and some of them don't even have pitch decks. Those people exist. And a lot of times it's because they've had a track record from prior, but not always. And so it is really tough at that very early stage. Some of the things I love, so I typically don't invest at pre-seed. I typically invest at seed. And the reason that I do that is
And can
because,
you, and sorry to interrupt, Angel. Can
yeah,
you just quick clarify for everyone? Everyone has a different definition. Pre-seed even
yeah,
itself is an entirely new category. How do you define
yes.
those two?
Yeah, okay, so that's a really good question. So different people have different benchmarks. It's become very blurry. You're absolutely right. So I would say anything over 1 million in your raise is what I would typically refer to as a seed raise. But the seeds, it depends on geography and it depends on your sector. So, so for example, life sciences, a seed round, I've seen like $20 million seed rounds. Like, I mean, it can really vary. So it depends on your sector. But for me, anything that's above $1 million raise is what I would typically call seed. And I'm not basing it on evaluation or anything. It's just the amount of the raise. And yeah, and sometimes I think people get caught up on what they're calling the raise, and there's so many different things like A plus and like all these different new terms. I wouldn't get too caught up. I would get very focused on how much you really need and what kind of outcomes you think you can produce because what you don't want to happen is a down round. And a down round basically means that you've raised on a particular valuation, and then you're getting to that next stage where you can't justify that valuation. And so then you have to decrease the valuation. No investor or founder likes to be in that situation. So, and sorry, your question again, Mike?
And the question was around like how, that tricky, they need capital
Oh,
to get traction,
right.
but the investors are saying they need traction to get a capital. So what
Yeah.
would you say to
So,
them?
yeah. So
And how
traction.
do you, and sorry, and how do you evaluate traction if it doesn't
Yeah.
have revenue? What are the other markers you look for?
Yeah. So some of the things that I personally look for, and again, it really depends on the business. So, for example, in an AI healthcare business, healthcare, has long. It's typically, well, mine have typically been enterprise as opposed to consumer, but I've done consumer like Levels and some others as well. The if it requires any kind of FDA approvals, that's a very long process normally. So some of the things that you can show, again, depend on your sector, but wait lists for a particular product can be, very helpful. If you've been able to show you've got a massive wait list for people that are like ready to buy on like day one. If you have any pre-sales, obviously that's, revenue, but if you've got, in some healthcare, mental health, if you can show white papers that are getting a lot of attention from very credible sources, if you can show pilots that you've had agreed, like those are contracted pilots with partners, if you're an enterprise business. Consumer can also be, it depends on if you have a freemium model. Like a lot of times as an investor, I'm not really overly concerned about revenue, but if you can show usage, you can show engagement, and you can show retention. So people are coming back, you're not losing them. And then on the revenue side, I would say, uh, you know, it can be difficult to go in different directions with pricing, and it can be difficult to ascertain, what the right pricing would be. But I think if you can have an offer um, where you're getting people, through the front door, you're getting them to sign up, you are getting useful data points from them, some kind of engagement showing that they're actually using something that you have to offer. And you can show that they're kind of continually coming back. They're not just like using it and then they drop off and you can't recover them. So, and even if it's in a very niche audience, right? So sometimes as founders, we can think of like, what's our end vision state? And oh, we want to give this to everyone in the world who is dealing with this problem. Like the more narrow you can get it, I am totally okay with the most narrow or niche, like customer base or audience, as long as you can show like like the customer acquisition or user acquisition that you have is becoming more effective. So you're able to get them on quicker, even if it's still expensive. And when I say expensive, that could be time or money. Typically, it's not money when you're at the really, really early stage because you can't afford it because you don't have the capital. But if you can show that whatever growth triggers you're using are actually creating some momentum, some traction, some scale, then even if it's a super niche audience, I can see how you've been able to capture that audience. And then I'll give you the benefit of the doubt that you're going to be able to continue to find these growth triggers for other like audiences or avatars, customer profiles. So
Mhm.
yeah.
No, really great insight. And what you're pointing to is at the early stage, obviously, it's more challenging. It depends on the industry. We're kind of looking as early stage investors at different benchmarks. Also, I put in the chat fi.co/benchmarks, just kind of industry standards. These are very general things depending on the industry you're building in, general round sizes, general traction milestones from a revenue customer standpoint. But I think you bring up some really great points there, Angel. So let's, we're with 13 minutes left and we have some great questions. Again, if you have questions, I see some of you put them in the main chat. If you want to put them in Q&A, we'll see if we can kind of power through them. And okay, so Mickey's second question is, he's asking about pros and cons of structuring startup as C corp versus an LLC. I'm just going to answer on my end and through
Yeah.
Founder Institute. C corp, full stop. We don't invest in LLCs,
Yeah.
and there are a variety of reasons for that. We go into it in the legal section, but what are your thoughts on that, Angel?
So same, I know angel investors who will invest in LLCs, but they're typically not in, tech or many of the industries that I would invest in. I typically see investments in LLCs for people who invest in small businesses, more service oriented, retail, things like that. Some consumer products. So I don't invest in LLCs, or at least I never have. But it's a different type of investor who would invest in LLCs as opposed to C corp. Yeah.
Yeah, and I did just remember what I was going to say is to just rewind to what you kind of saying earlier, in the early kind of traction. What essentially you're looking for, signal among the noise,
Yeah.
and what eventually that turns into for you were talking about like ways of acquiring customers, especially in growth stage. What VCs will start looking for is what's called the CAC to LTV ratio, right? How much does it cost for you to acquire a customer, and what is the lifetime value of that customer? And you
Yep.
want a pretty good ratio there. And I think what Angel, you were speaking to across different industries is like, can you show that there's something there and you understand how to acquire customers, and then that the value of those customers for the lifetime is a meaningful one. So, okay, as a non-technical founder, how do you assess potential of a founding team in tech-heavy startups? I see this a lot, right? Founder comes in, big visionary CEO, does not have maybe the technical chops, but they want to build in tech because it's the most scalable. It's the largest kind of multiples. What are your thoughts there? How do you assess teams if tech-heavy startup, not technical founder?
Yeah, then you have to find a co-founder. Full stop.
Yeah,
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 you just
I'm with you.
or you have to be in a financial position to hire a super, super strong head of engineering, head of product. So if you are able to self-finance or you're able to raise, so for example, there you could meet a head of engineering or a CTO that has fallen in love with your vision or your business and might say like, hey, I'm not leaving Google and unless, you get your funding, but I will join if you get the funding. And so, and as long as they're okay with you putting them in the deck and you telling investors, this is the team that I'm going to bring on and they've already committed, then, then I would feel more confident about that. But if it's a tech heavy startup and you don't have that in place, then I'm definitely not investing.
Yeah, I'm with you. I shared two additional links. I hope this hour is really as helpful as possible. I hope, again, whether you're part of the accelerator or not, I hope every founder leaves, a better founder, a better human for having joined us for this hour. But two additional resources. First one you see is fi.co/fast, which is an advisor agreement for equity. To Angel's point, we look also for technical co-founders. We want technical teams. But a lot of times, and you'll see this in FI curriculum, if you go through the program, you want to build out a strong advisory team. So if in areas where you're lacking, maybe it's on the marketing side, maybe it's on the your technical side, whatever it is, you can you can create good incentive structures for equity where you don't have to pay cash up front. So we're trying to keep this as lean as possible for founders. The second one is the ease agreement, which is the same kind of thing. It's for service providers. So if you are outsourcing to dev shops, if you have additional service providers you're working with, again, to try to maintain cash and keep, we know that founders are kind of bootstrapping for the most part and trying to get traction early on. So this is a way to incentivize these different advisors, service providers, and team members with equity instead of cash upfront. Okay, let's go lightning round. Oh, sorry, do you have something to
Oh,
add,
yeah.
Angel?
One thing I want to say on that real quick though is that investors are going to want to know what those advisors are actually doing. So if you just have an advisor name on there and that's somebody that you check in with once a month to just like, talk about ideas, that's not enough. So if you're going to have an advisor, be really clear about what your expectations are from them And sometimes it's actually doing stuff, not just like telling you how to do stuff. So really make sure that you're both aligned as to how they're going to contribute. And if they're not contributing in a meaningful way, and that could be just advice, opening doors, making introductions, then don't put them in your deck, or don't mention them. Just having a name in
Mhm.
there is not enough. Make sure that if you're gonna go through the effort of getting this agreement in place, that you're both really aligned and that they are really like adding value. Because as an investor, it's only meaningful to me if you have advisors who are really committed to your success.
Agreed. Yeah, wonderful. Okay, we're gonna go lightning round style just because I would love to get through every question, which is gonna be tough. So we'll try to let's try to keep them to 30 seconds or less. And I'm gonna start with probably the hardest one to keep to 30 seconds. Are you ready for it?
Yes.
So can you share what you've learned? Don is asking, can you share what you've learned in all the years of investing more towards understanding human psyche? So and has it changed your perspective of the world? Can you do
Yes.
that in 30 seconds?
Yes, I can.
Oh, okay,
Almost everyone makes decisions based on emotions and uses data and facts and figures to justify what they're already feeling emotionally. That's one of my takeaways.
wow. That is so good. I love it. Okay. Um, we have an anonymous attendee asking, would you recommend startup founders in the ideation stage to join a pre-seed incubator rather than seek traditional sources of capital? My quick plug is 100%, especially first-time founders, 100% yes. It keeps you focused, introduces you to mentors, investors, advisors. Curious your thoughts, Angel.
Yeah, an incubator, a kind of, pre-accelerator, a boot camp, or a community, anything that helps you um, get to refining what it is that you're building, so that when you do take it to those first rounds of conversations to investors, you've anticipated most of the questions and at least have some resemblance of an answer, and have had feedback from really good, other sources. And peers are oftentimes also great sources.
So good. What advice do you have for founders that want to reach out to angels and investors when they're raising? Cold emails are tough, but obviously they know that warm network leads are the best. Is there guidance on how to approach investors?
Yes, try to build the relationships before you're actually raising, commenting on their social media in an additive way, like, oh, you just posted about X, like, hey, have you seen this article, and posting it there so that they start recognizing your name before you're going in for a pitch. Make sure that you've really researched the investor first, knowing what they invest in and getting to why this would be a good investment for them, thinking of investors as humans first, not just ATMs. You got to build that real connection as humans first, because if I want to see you win, a lot of times I'm going to invest in you. I told you my story about my first angel investment. I invested because I was investing in the founder, even though I was highly skeptical about the business. But we had built a relationship of trust, and I was committed to that founder winning. So really, really personalize that cold outreach as much as possible. Keep it as succinct as possible, making sure that you're referencing like, oh, I know you invested in X and we're in a similar space, but not competitive. And we want to achieve the same goals. We know that's important to you. Would you be open for a call? So keep it succinct, highly, highly personalized. It is going to take time. Do the research, and when you do get a no, which is going to be the vast majority of the time, you can follow it up with a question. What would help you get to a yes for a call or for an investment? Or who else do you know who I should talk to either get feedback or who might be interested?
Yeah, and that goes along. Zach Kohler is asking advice to non-traditional background founders, finding, connecting, getting meetings with early stage investors. So you answered a lot of those questions. I would say also programs like this, networking events. Again, part of FI. Every week you're meeting different investors, mentors, advisors. Yeah, and I think you shared a lot of great resources for how to kind of reach out to them the right way. Um, Human
Events like these
HUI.
are great too. Like, I'm here. You can follow up on Twitter. You can follow up on LinkedIn and say like, hey, this point that you made about X, I found really helpful. This is where I'm at. Are you able to have like these kinds of events that Founder Institute hold? Like, it's a great opportunity to follow up with whoever is, in that conversation.
Yeah. Yeah. Glenn Dawson asked kind of a technical question on Sibber and Sitter. Glenn, I'll get back to you later about that, just because I probably have more insights on that. Human is asking, what are you looking for in terms of equity split among founding team?
Okay, so, in terms of an overall ESOP, like I've seen much more of a trend towards 10% for the general ESOP, so the whole team, but up to 20%. And amongst co-founders, it depends on how many co-founders there are. And it also kind of depends on, are they full-time? Are they not doing anything else? So they don't have a day job? Like, how early are you talking about? And so it really does depend on those factors. If they're genuine co-founders, then I would expect it to be pretty even between them, regardless of whether one person is a growth person or a product person or, CTO, whatever. I would generally expect it to be pretty evenly split amongst co-founders.
Yeah, great. And Rob Jones on that co-founding side says he speaks to the founder. He has people on his team that were there from the start or near the start. When is someone in your mind kind of too late to be a co-founder?
Okay, so this is a hot button for me because I like, just as a founder, it is so difficult being a founder. It drives me nuts when people come in like much later and then they're given the like co-founder title. It drives me insane, but that's just a personal thing. It is totally up to you because, so for example, one of the companies in my portfolio had been around for 4 years and they were getting a lot of traction. Um, and somebody came in as a chief growth officer, and after about a year or so, they ended up giving that person a co-founder title, and it drove me nuts. But the reasoning I thought was valid, and the reasoning was she had fundamentally shifted the momentum of the business in a much more scalable way. And so, taking the business from pre-seed to seed to series A and getting it to a stage where you can come to me at Influence Partners as wanting to raise your series B, or acquire other companies or get acquired. That step change between A and B is massive. There is a massive like like dropout of companies that actually make it to that next stage. So I would say technically you can call a co-founder whenever it feels right to you. But I would say that the later it is, like a year and beyond, then I would say they have to have done something really demonstrable to shift the business in a very positive way. And so you're probably not giving it to them right in the offer letter. You're probably doing it a little bit later, unless there's some kind of powerhouse that will fundamentally like transform your business if you can bring them in.
Yeah, great insights. Glenn Dawson, and we're going to go 2 more minutes. Angel, are you good for 2 minutes?
Yeah.
Awesome. Glenn had asked, what preferred time in an investment before we look for an exit? I'll quickly just answer on our end so everyone understands. Most funds, especially early stage funds like mine, are 10-year the fund life. We have the option to extend 2 years. We're traditionally looking for liquidity events, years 5 to 7, may happen as early as year 3, but just to understand, usually kind of years 5 to 7. What are your thoughts on preferred time?
Yeah. So one thing I want to say on that super quick is I do not recommend ever putting in a deck or a first conversation unless you are asked anything about when you anticipate an exit. Investors typically, or at least this investor, wants to know you are in it for the long haul and you're focused on value creation. Like, I don't want to think that you are ready to jump at the first like opportunity, because usually the valuation is not optimized by that stage. And it also tells me like, if things get a little bit bumpy, you might jump ship. So I don't recommend talking about it in a first or even the first few calls or putting it in your deck. So just want to put that out there unless you are asked. So everything that Mike just said is true for most funds and most investors. So at the growth stage, when we are typically working with founders to either fundraise or explore M&A opportunities, we're typically looking at a minimum of around 10 million in ARR. So getting to that stage where you're starting to get to that scale. Again, it depends on your sector. The other thing that I would say is, I don't look, when I'm looking at potential companies to have M&A conversations with, I typically don't look for companies that are anywhere under 5 years operational. I would start to have the conversations at 5+ years, because it might take, 2 years or 3 years before the opportunity is really ripe. But yeah, I think everything that Mike said is pretty, par for the course. But 10 million ARR, plus at least 5 years. Now, that being said, as a founder and as part of a founding team, I've had exits within 3 years, and those are 100x exits, but that's rare.
Everyone should invest in Angel as the founder. Okay, let's land this plane, Angel. You've been amazing. Thank you so much for your time. Again, I hope that the hour that everyone spent with us, I hope you are, better founders, better investors, better humans for having joined us. There were still some questions left. That just means we'll have to do it again. Maybe we'll, not Clubhouse. We'll do like a Twitter Spaces, get people going. Let's do this. Last 30 seconds to wrap. How can people connect with you? I put your LinkedIn in the chat. I know you're active on Twitter. You obviously have Angel Club for the investors that are joining us live or watching this replay later. Tell us a little bit about how to connect with you.
Yeah, sure. So yeah, those are all great places. LinkedIn is great. Twitter is great. I'm just at Gambino at Twitter. You can also email me at info at angelgambino.com. And those are the best ways. There's lots of other contact details at angelclub.com. So it's a community that I run for angel investors and angel stage startups, focus on fundraising and growth. And so any one of those ways are great ways to reach me. I'm also very active on WhatsApp, as you know. So
You're
yeah.
on it.
So if you reach me at one of those other ones, then I can invite you to various different WhatsApp groups.
Awesome. Well, thanks again, Angel. I cannot, first of all, express enough gratitude having you as a friend in my life. Thank you for all the great insights. Excited to reconnect in the Bay Area here in a few weeks. And thanks for spending the last hour with us and hopefully helping create better, founders, investors, and humans in the world. So have a wonderful rest of your day. Thank you, everyone, for joining us. Thanks again to Angel, and we will see you soon.
All right. Thank you, Mike. Thank you,
Take
everyone.
care, everyone. Thanks again. All right. Bye.